Hello and welcome back to the Tellone Perspective. I'm your host, Dean Tellone. For most people, taxes are something you think about once a year, usually in a panic around April. You gather up your W-2s and 1099s, drop them off with your accountant, and hope for the best. This is what we call reactive tax preparation. It's a backward glance at a year that's already over, with very few opportunities to change the outcome. But what if you treated your tax strategy like a GPS instead of a rearview mirror? What if you could look ahead, map out the best route, and make smart decisions throughout the year to arrive at a better destination? That's proactive tax planning. And in today's episode, we're going to discuss how this simple shift in mindset from reactive to proactive can make a significant difference in your financial life. Let's start with a clear definition. Reactive tax preparation is the process of filing your taxes based on events that have already happened. It's a historical record. By the time you're filing, the tax year is closed. You can't go back and increase your 401k contributions. You can't sell a stock to harvest a loss. And you can't change how you received your income. Proactive tax planning, on the other hand, is a year-round process. It's about looking at your financial picture in real time and making strategic decisions to minimize your tax liability before it occurs. It's about turning the tax code from something that happens to you into a tool that you can use to your advantage. As an enrolled agent, I've been legally representing taxpayers before the IRS since 1991, and I can tell you, the clients who have the best outcomes are the ones who engage in planning throughout the year, not just in April. So how do you become proactive? You adopt a quarterly cadence. Instead of one big push in April, you take small, manageable actions every few months. Here's what that looks like. Quarter one, January to March, is about setting the foundation. You've just finished the tax year, so it's the perfect time to review your return. What was your effective tax rate? Were there any surprises? This is also when you should set your goals for the new year. Max out your 401k and HSA contributions. You can also still contribute to an IRA for the previous year right up until the April 15th tax deadline. Quarter two, April to June, is for tracking and adjusting. Did you get a raise or a bonus? Did your spouse change jobs? Any significant change in income requires a quick check of your tax withholding. The IRS has a great tax withholding estimator on their website. A few minutes here can prevent a big surprise next year. Quarter three, July to September, is for forecasting. Now that you have over half the year's data, you can run a mid-year tax projection. This will tell you if you're on track. It's also the time to start looking at your investment portfolio. Do you have unrealized gains or losses? This is when you start planning for tax loss harvesting. Quarter four, October to December, is about execution. This is your last chance to make most of the moves that will impact your tax bill. Maxing out retirement accounts, making charitable donations, selling investments for tax loss harvesting. Most of these have a December 31st deadline. This is where all the planning you've done throughout the year pays off. Now let's talk about some of the specific strategies you can use in your proactive planning. These are just a few examples, and not all will apply to everyone, but they illustrate the proactive mindset. First, managing your retirement contributions. Are you maxing out your 401k or 403b? For 2026, the limit is projected to be around $24,500 for those under 50. That's a significant tax deduction. If you're over 50, you can contribute an additional catch-up amount. The same goes for health savings accounts, or HSAs, which offer a triple tax advantage. Second, tax loss harvesting. This is the practice of selling an investment that has lost value to offset the taxes on gains from your winning investments. This has to be done by December 31st, which is why you need to be looking at your portfolio in Q3 and Q4, not in April of the following year. Third, charitable giving. There are many ways to give to charity that are more tax efficient than just writing a check. You can donate appreciated stock to avoid paying capital gains tax. Or, for those over 70 and a half, you can make a qualified charitable distribution, or QCD, directly from your IRA. This satisfies your required minimum distribution, but doesn't count as taxable income. Fourth, income and expense timing. If you're self-employed or own a business, you have some flexibility. If you expect to be in a lower tax bracket next year, you might defer some income. If you expect to be in a higher bracket, you might accelerate some deductible expenses into the current year. Ultimately, proactive tax planning is about a shift in mindset. It's about viewing your taxes not as a once-a-year event, but as an integral part of your overall financial plan, just like your investments or your estate plan. It requires you to be organized, keep good records throughout the year, not just in a frantic search for receipts in March. It requires you to be forward-looking. Think about where you want to be financially in 1, 5, and 10 years, and how your tax strategy can help you get there. And most importantly, it requires you to seek advice before the year is over. Your financial advisor and tax professional can provide the most value when they have time to be strategic. A simple phone call or meeting in June or September can open up planning opportunities that are long gone by the following April. To sum it up, don't be a rear-view mirror tax filer. Be a GPS tax planner. Look ahead, anticipate the turns, and you'll find yourself on a much smoother and more profitable journey. Thank you for tuning in to the Tellone Perspective. Join me next time when we'll continue our discussion on taxes and explore the specific role of an enrolled agent.